Good afternoon, everyone. My name is Samantha Ellis, and I'm one of the TBA YLD CLE chairs. I am here today to introduce our speaker, Holly Floberg. Holly attended Tennessee Wesleyan University, where she majored in business administration. She is a Master of Accountancy from the University of Tennessee at Chattanooga and attended Washington and Lee School of Law. Prior to law school, she was an accountant for a regional grocery chain and taught accounting and finance classes at Tennessee Wesleyan University. She joined Grant, Convalenca, and Harrison in 2016 and was recently made a director. She practices primarily in the areas of tax planning, tax controversy, transactional law, transactional tax, estate planning, and business law. She serves on the board of the Downtown Council of the Chattanooga Chamber of Commerce, is the current treasurer of the Southeast Tennessee Lawyers Association for Women, and teaches adjunct accounting classes for Tennessee Wesleyan University. So now I will pass it over to Holly.
Thank you, Samantha. So I'm excited to get to, have this opportunity to share with you some accounting knowledge this afternoon. It is a 101 course, so it's going to be like the 75,000 foot overview. So with that being said, I'm sure I'm going to be cutting it close with the slides. You just never know how much to put in here. So let's go ahead and begin. So what is accounting? Accounting is not simply math. A lot of people in the non-business people might think it's a math. It's not really a math. It's a complex system of classification that's used to measure and process financial information about business operations. So it kind of levels the playing field. We can compare one company to another company, or we can determine what's going on with a company. Are they doing well? Are there reasons to be concerned? Now, there are three primary topics that we'll discuss. We're mainly going to discuss financial accounting. In the US, financial accounting is governed by GAAP, generally accepted accounting principles. And financial accounting is primarily used by external stakeholders such as creditors and stockholders. There's other people out there that are going to look at your financial information, and a lot of people want audited financial statements. And so that's where a lot of our CPAs come into play. They're going to audit the financial statements of businesses and ensure that the financial statements actually are accurate and, with what they're communicating. Now, managerial accounting is used to provide information to internal users, such as management, to make business decisions. And we'll look at some financial statements here shortly, and some other information with a publicly traded company, and we'll get to see some of their what I would consider more of a management information, managerial level accounting, such as, what is the average cost, what is the average ticket per customer? Obviously at Walmart, they probably want to know. They might be able to tell us that the average transaction is, $62.50. Obviously, they would prefer that transaction be as high as possible. So that's important information for management. And then there's also tax accounting. Tax and accounting oftentimes get confused. They are not the same thing. There are different rules in tax accounting, if you will. We have to follow the Internal Revenue Code. For example, depreciation methods. Now, the tax code requires us to use, MACRS, Modified Accelerated Cost Recovery System, to determine depreciation. Financial accounting allows us to use many different methods. For example, the classic example is straight line. I think most people, even if they don't really understand a lot about accounting, if we're talking about depreciation and they know what it is, straight line is probably what they come up with. Now, straight line is simply the cost of the asset less whatever salvage or residual value divided by the number of years you plan on using the asset. Now, depreciation is a function of several things. The asset cost, if there's a salvage value, useful life, and pattern of use. The goal is to match the cost of using that asset with the revenues derived from that asset. So what we have is we have a difference between book and tax, because most people are not going to record their entries in their accounting system, their book accounting, using the tax depreciation method of MACRS. So there's going to be a difference there. So when you report income on your financial statements, your income statement, it's going to be different than tax income. Now, there are some other differences that might be of note. For example, the IRS will make a rule such as parking in certain instances is no longer deductible on your tax return. Entertainment and entertainment's not deductible. Meals are only 50% deductible. So that's going to generate your financial accounting versus your tax accounting. Those are going to generate book versus tax differences. So those are things to be aware of if you're looking at someone's financial statements, and then you're also comparing it to the tax return. They're not always going to be the same. Now, depreciation, depending on the type or what you use as far as depreciation is concerned, that's going to affect your bottom line. That's going to affect what you're reporting in your financial statements as net income, or in some cases, net loss. So accounting and the law. Accounting and the law, they cross paths quite often. So one of the easiest places to see, I think, is domestic relations. So if you have clients that are going through a divorce, and obviously, most of the time, one spouse is going to be disadvantaged as compared to the other, or one spouse, is going to end up paying more child support. Or how are we going to divide these assets? Maybe one spouse is a business owner and the other spouse is a stay-at-home parent. Well, what is the value of the business? If we're trying to divide it, what does the spouse that what is the spouse that stays at home? What are they entitled to? So accounting comes into play there. So obviously someone's going to be looking at the company records if there's a company at issue. They might also look at financial assets. What does spouse A have in the bank? Do they have an IRA? Do they have, a savings account? Do they have CDs? Do they have brokerage accounts? And they're going to compare that to spouse B. So essentially, you're adding up the assets of one spouse and comparing them to the assets of another spouse. And you're going to determine, does one spouse get more by way of assets? Does one spouse get alimony? And then you're going to be able to determine the amount of child support based on each spouse's income and based on the expenses that are being paid. Now, accounting and the law also comes into play when you're talking about entity formation. So when you're considering whether you want to form a corporation, whether it be a regular C Corp or an S Corp, or whether maybe you want to form a partnership or a limited liability company, or if you just want to be a sole proprietor. So part of that is going to be, you're going to have some accounting concerns. So how much capital do we need to operate? We're going to have to do some projections here if we want investors. We're going to have to prepare some projected financial statements if we're going to attract people to invest with us. Are we concerned about tax issues and tax accounting? If we make an S election, obviously the tax attributes are going to flow through to the shareholders. If we leave it at a C Corp, then the corporation will be the entity that's taxed. And if they want to pass dividends to the shareholders, then the shareholders are going to pay a tax on that dividend. So there's double taxation. Partnerships and LLC agreements, you will see the 704B language from the Internal Revenue Code about maintenance of capital accounts. And that is an accounting thing. So it's important that you at least can recognize what are in some of these documents. Contracts. Who owns specific assets and at what point? A lot of contracts, you'll see language such as FOB shipping point and FOB destination. Well, that's pretty important to understand, because when you're looking at a company's balance sheet, the question is who owns the inventory? And the contract is going to tell you at what point title changed hands and on whose balance sheet it should be presented. So that's another area. Now, what about damages? If the contract is breached, what about lost profits? You should be able to at least understand how we're going to calculate the lost profits of the company or the individual, if it's lost wages or what have you, for the period at issue. So again, accounting comes into play there. Now, you and I may not be calculating those, but at least you understand what the accountants are providing you. Mergers and acquisitions. There's going to obviously be a period of due diligence if you're going to purchase another business or you're being purchased by another business. They want to make sure that your accounting records are accurate. What are the value of the assets or the interest being purchased? How are they valuing that? What method are they using? Are they using to value that? There's many methods that can be used. You can look at income statement type methods. You can do some multiple of revenues. You can look at the assets of the business. So, there's several different avenues that accounting becomes pretty important in mergers and acquisitions. Estate planning. The value of your assets and your liabilities at death or when you're gifting. It's important to understand the value of those assets. And by value, first of all, there's two concerns here. There is what you paid for the asset, which is your basis in the asset, and there is the fair market value of the asset when you die. Why is that important? Because someone's going to get the fair market value at your death. If you give something, that's a little different. They get your basis. So if you paid $100 for, your stock, your shares of stock, and now the stock is worth $1 million, that's a big difference. So it does play a part in determining whether you should gift assets now, whether you should try to keep them until you pass away and then pass them on that away. And also, if you think about it, if you probate, there's also some opportunity for accounting there, because you're looking at all the assets that came into the estate, and then you're making sure that all the assets, the executor has distributed all those assets. So, there is, and you may have to, in fact, prepare a formal accounting. So, for the court. So that is another area. So let's talk about some of these financial statements, and I hope you can see the slides. We're going to do some other screen sharing here in just a second. Financial statements, the balance sheet. The balance sheet is a measure at a specific point in time. For example, as of January 31st, 2023, not the month, just the date. The balance sheet would be different on February 1st, 2023. Your bank balance would be different because chances are good you had transactions coming in and out of the account. So one point in time. So this is where we derive the standard accounting equation, if you will. Assets equals liabilities plus equity. So assets, these are tangible or intangible property that provide positive economic value. Now, there's several types. There's current, and generally you expect, they'll be received or turned over in a year or less. So in general, so in current assets, we generally have cash and cash equivalents. And by cash, don't confuse credit cards in the accounting world are generally considered cash. So when you have receipts from your credit cards that are coming into your bank account, even though it takes a couple of days to clear, they're generally lumped into that cash total. Accounts receivable, okay, those are, I've sold something to someone on credit, they've signed a contract, or, they've signed a purchase order, and they're going to pay me in, let's say, 30 days, 15 days. They're not paying at the point of sale, if you will. Okay, so they're taking the goods, or you've provided the service, and they're going to pay you some time period later. Inventory, it's also a current asset. Inventory, generally these are items for resale. Walmart has inventory, right? Lowe's has inventory. Manufacturing businesses have inventory. They're selling it to somebody. Property, plant, and equipment, those are long-term assets. And these are physical assets that are not used up during the year. So they have a long-lived value. Your building is an asset. If you purchased an office building, your building is an asset, a long-term asset. If you have any type of machinery, those are going to be assets because you're going to keep them hopefully more than a year. Long-term receivables. Now, these are things that are going to be paid in over a year. So they're claims to future assets. So let's say you agree, think about promissory notes. If someone executes a promissory note in your favor, and let's say it's for a 5-year note, that's going to be a long-term, a note receivable. That's how that's going to be displayed on your balance sheet. Intangible assets. Now, these are trademarks, copyrights, goodwill, patents. I will note here, goodwill can only be purchased. Okay, so unless you buy another entity, you're not going to have goodwill on your balance sheet. You cannot internally create goodwill. The classic historical cost versus fair market value conundrum, if you will. So, for example, with historical cost, that's generally how GAAP requires us to report most things on the balance sheet. That basically means the price I paid for it is what it gets reported at on the balance sheet. So let's say 10 years ago, ABC Company purchased land for $100,000. And we all know what the market's doing at this point. So let's say now, and they build a building on it, and the land's 100,000, the building's worth 50,000, whatever. So now the land, because of the market, is worth $1 million. We are still showing the land on our balance sheet is $100,000. So there's this constant pull of, is historical cost really the most accurate information available, or should it be fair market value? Well, the problem with fair market value, i.e. displaying it at that $1 million, is, does this give people incentive to artificially inflate the price? And there are classic examples from our accounting past, such as Enron, that inflated a bunch of their contracts and their reserves on their books. So what happened is they were essentially, you might as well say they were making up numbers in a lot of cases. And I mean, we all know the story of Enron and what happened, financial collapse and ruin. Accountants got in a lot of trouble. There were a lot of lawsuits and whatnot. So we're still firmly in the historical cost camp here. The only thing that we generally allow at fair market value are trading securities, securities that you're generally trading on the daily or on the weekly, publicly traded securities. You have them for the purpose of trading in them. Those are better valued at fair market value. So now we get to the other side of the accounting equation and we can talk about liabilities. So liabilities are debts that are owed. And obviously we have a couple of types. We have the current, which are going to be due and payable within a year or less. And those are generally accounts payable. And, you know, you have a lot of trade, when you're trading things such as, or excuse me, not trading things, but when you're buying and selling inventory or things of that nature, that's where you develop a lot of accounts payable. So basically, not credit cards, but if someone sells me something on account and gives me 15 days to pay for it, that would be an accounts payable. Long-term debt due to be paid in more than a year. You have mortgages and you have notes payable. Think about a mortgage might be 30 years. It would be on the balance sheet there. Notes payable. If you promise to pay somebody something in the next 5 years, you would put that in that category. Another big liability that's long-term are bonds payable. Now, I will just say, as far as bonds payable are concerned, when you see them on the balance sheet, you know, in theory, you're going to see bonds payable and then the face amount of the bond, i.e. how much cash you received. Now, if the interest rate isn't fluctuating very much, then you will just see bonds payable and whatever you received, or excuse me, whatever, you received for the bond. However, if the interest rate is in flux, i.e. it's before you've issued the bonds, it's changed, and you have let's say when you have a bond, you have $1,000 bond, you're issuing them in increments of 1,000, and the bond is a 5% bond. That means it pays 5% annual interest, right? So, if you issue it and the interest rate hasn't changed, then you're going to get $1,000 for the bond, for each bond you sell. But if the interest rate has changed, let's say the interest rate shot up to 10%, then nobody's going to pay you $1,000 for that bond that's paying 5% interest. So you're going to sell it at a discount, and then you would display that under the bonds payable section. So it would be, bonds payable, and then you would have, discount on bonds payable. The opposite can be true as well. If your bonds are paying more than the market rate of interest, then you can sell them at a premium, and you would have a premium on bonds payable. So equity is each owner's residual interest in the company. So you've got your assets. If you take away your liabilities, this in theory should be what your owner's value is, and it depends. There's different types of equity sections that you're going to look at. There are just plain old owner's equity. And when we think about that in the accounting world, that's generally a sole proprietor. You also have partners. Partners have their capital account balances. So John Smith, comma capital on your balance sheet. You also have stockholders' equity. Now, stockholders' equity, if you have a corporation, generally you're talking about contributed, and earned capital. The contributed would be, let's say, a public company issues stock and its par value is a penny, and they sell it for $10 a share. Well, the paid in capital is a penny times however many shares. The other account, where you have the additional $9.99 per share, goes to paid in capital in excess of par. And that's how that works. Now, everybody's probably thinking, or maybe you're not, why do companies issue shares of stock with such a low par value? Well, in theory, if the market price falls to less than par value, the company may have a theoretical liability to the shareholders. So that's why they try to issue stock at the lowest par value possible. Now, the balance sheet Oh, and sorry, retained earnings. I meant to speak about that. Retained earnings is, that is your accumulation of net income over the years, what you haven't paid out to shareholders in dividends. So the next financial statement is the income statement. Now, the income statement is different than the balance sheet, it does not it does not measure a specific date. It measures a period of time for the year ended December 31st, 2022. So I know that if an income statement has that on there, it's going to measure from January 1st of 2022 to December 31st of 2022. Now, the basic equation for this, if you will, is revenues less expenses. So what are revenues? Well, it depends on the type of business. There could be service revenue. There could be sales if you're selling merchandise, and we'll talk about the different types of businesses here shortly. So those are the types of things that you're going to see on an income statement. Now, if you are a merchandising business, such as Lowe's, Walmart, you're going to have cost of goods sold. Now, cost of goods sold it's an interesting account, and I say that because generally when we buy something and we receive it, most things we go ahead and expense it. So if I pay somebody's salary today, I go ahead and expense it. Now, cost of goods sold is a little different because I purchase inventory today to sell. I don't get to expense it immediately. Inventory is an asset. So it doesn't get expensed to cost of goods sold until I actually sell the inventory. So that's how that's kind of a little unique. And cost of goods sold, we have our beginning inventory, and it could be zero when you're obviously a new business, plus any purchases we make, less our ending inventory. And then you have cost of goods sold. And there's also inventory shrink that is obviously an expense, because I will tell you that 99.9% of the time there is going to be shrink, as in lost inventory, stolen inventory, however you want to look at it. And, it's particularly high, and I can speak to this because I worked in the grocery industry for a long time. It's particularly high in the grocery industry because people, they might take a piece of candy and eat it, open a bag, eat a banana, whatever, you're losing inventory. Other expenses are selling and general and administrative. So we have people, maybe an easy way to see this is think about people who are selling cars. Their salaries or their commissions or whatever would be a selling expense, right? You also have your general and administrative expenses. So you have a corporate headquarters. You have to keep the lights on. You have to have someone to actually perform the accounting, somebody to work in HR. Those are generally administrative expenses. Now, a lot of people talk about overhead allocations. And it can be pretty complex. There's a number of ways to divvy up overhead. And generally, when we talk about overhead, we're talking about expenses that are not directly traceable to a product or service. Not directly traceable to a product or service. So if you're in a manufacturing business and you're manufacturing cars, you cannot directly, people are not going to spend time directly tracing the screws or the lubricant used to grease lug nuts or whatever. They're not tracing that directly to a product or service. They are also not directly tracing the factory's rent to the product or service, to the specific product or service. So it gets lumped into overhead. We also see gains and sales, gains and losses on the income statement. So if we sell an asset that we've had, we may have a gain. We may have sold it for more than we paid for it. If we sold that piece of land that was on our balance sheet for $1 million and we only paid $100,000 for it, well, we have a $900,000 gain. Likewise, we may have a loss. We may have some equipment that's old and we just need to get rid of it. We need to recoup some of it. So we sell it and we show a loss on it. And those are things that will feed also into the tax return. Income or loss from discontinued operations. Now, accountants like to keep it separate, if you will. We want our normal, everyday income from continuing operations. And then if we decided to close a segment of our business, there's going to be a separate section that, that gives the income or loss from that segment that we've discontinued. And that's so we can compare, we can compare continuing operations over time. We can kind of take out the items that are abnormal, unusual, infrequent, whatever. Earnings per share. Now, earnings per share is simply your net income of the business, less preferred dividends divided by the common shares outstanding. So basically what we're talking about is we're talking about income available, or earnings available to the common shareholders. Now, the preferred shareholders, generally, preferred stock is close to debt in the fact that generally preferred shareholders are going to get paid first. Preferred stock, you might see it, you have 9% preferred stock. That means if it sells for $100 and it's 9%, you're getting $9 in essentially dividend per share that you own. So this is what we're taking out. We're taking out any preferred dividends that we've paid, and then we're dividing it by, well, technically we're dividing it by the weighted average common shares outstanding, but that's probably a little more detailed than we need here. Now, another important thing to consider is most companies large companies have complex capital structures. So you have diluted earnings per share. Well, I mean, you can also have anti-dilutive securities, but so diluted earnings per share, that would be, it's a measurement of EPS if all convertible securities, warrants, options, convertible bonds, if they were converted to common stock, then what is available to the common shareholder. So that's what diluted earnings per share will show you. Now, there are times that conversion of debt, so let's say you have bonds, okay, and they're $200 bond or $1,000 bond a piece, and you've got 10 of them. And let's just say they're convertible to 2 shares of stock a piece, common stock. Well, you're not having to pay that $1,000 back to the bondholder. They're going to get stock. So that's going to give you a boost, if you will, in income, because you're not having to pay that. You're not paying the interest on those. You're not paying the interest on those, rather. So you're going to have a boost in income. And if for some reason that addition to income, now you're also going to have more shares of common stock, but if for some reason that addition to income ends up giving you a higher earnings per share, it went from $1 to $1.10, then that security would be considered anti-dilutive and it would not be displayed. So now we're going to talk about probably one of my favorites financial statements, the often overlooked statement of cash flow. Why do I say that? Because it's harder to hide. It's harder to hide things in cash than it is in income. You can hide a myriad of sins in income that you cannot hide in cash. The cash is either there or it's not. So there are 3 sections. There is an operating section, and I will tell you that there are multiple methods to actually doing the operating section, if you will. Most people use the indirect method. So basically you make adjustments to net income. So you start with whatever your net income is or your net loss was, and then you make adjustments. You adjust for non-cash items like depletion, depreciation, amortization. So those are all added back. You adjust for gains and losses because they are going to be included in the investing section. So if your income statement displayed a gain, you would subtract it. If it displayed a loss, you would add it back. You also adjust for current assets and liabilities from the balance sheet. So if at the beginning of the year, your current asset, if you compare the beginning of the year to the end of the year, if your current asset increases, cash will decrease. So that will be a subtraction. So let's think about that. So we have accounts receivable, which is a current asset. So that means people owe us money. If it increases from the beginning of the year to the end of the year, that means more people owe us money. They're not paying us. That means we have less cash, right? So that's how that works. Investing is when we buy or sell long-term assets. And we're taking the gains and losses out of the equation in the operating section, because all we're talking about here is, what did I receive for the sale of my asset? Let's say I sold a building and I received $200,000 for it. That's what's that's going to be a cash inflow under that section. Let's say I purchased new equipment for $10,000. Well, that's going to be a cash outflow under that section. Now, financing is when we talk about how we're going to finance our operations. Two primary ways that we think about. We either sell, we either sell common stock or preferred stock, or we issue debt or bonds. So, so when we're paying off the bonds, obviously that would be a cash outflow. If we are issuing new shares of stock, that's going to be a cash inflow. So what we're doing is we're seeing, where our cash is coming from and where it's going. That's what type of report that is. So operating, you definitely don't want to be losing. I mean, obviously you don't really want to lose money, but you don't want to lose money in the operating section, because that is your income from operations. This is your core business. Sometimes you're investing, it takes money to make money, as they say. So when you invest, you are getting, hopefully long-term benefit. The next and final financial statement, and it's probably going to be better to actually see this one, and we'll look at it in a second. So it's prepared for a period of time, year ended December 31st, 2022. And it's going to show your beginning balances, plus what shares you've issued during the year, less purchases of treasury stock, plus any income, if you had any. Obviously, if you had a loss, that would be deducted. Less cash dividends, if you paid any, less stock dividends gives you your ending balance in the account. So, common stock at par value, we've already talked about that. We've also talked about paid-in capital in excess of par. Retained earnings, obviously, that's the accumulation of all the income over the years, what's going there that's not paid out in the form of a dividend. Treasury stock, that's when businesses decide they want to have less stock out in the market. They'll go and repurchase stock from their shareholders, or maybe the shareholders don't want to be invested anymore. If it's a small, closely held business, and they sell their stock back to the corporation. And this gives us total stockholders' equity. So let me see if I can share. Hopefully everybody can see this. Now, what we're looking at, and this is a financial statement, a bunch of financial statements. This happens to be Lowe's, and this is Lowe's 2022 annual report. Now, I happen to have gotten this from Lowe's website. They have an investor relations section. So that's always a good place, particularly with publicly held companies. If you look at their investor relations section of the website, you can see all sorts of information about them. Now, generally, I would go to the SEC Edgar's database to get my information, because it doesn't include the fluff. And by fluff, I mean there's not lots of pretty pictures going around. This thing is probably like 100 and something pages, where it's 108 pages, whereas the one on the SEC website is not going to have all this, additional stuff that isn't necessarily what we're looking at. So you can kind of see, here is an income statement of a publicly traded company. You can see that 2022 and 2021 are displayed. So you can compare. You can see, the net sales, the gross margin. So that's nice. It's not detailed at this point. So you're just seeing, the overview. But this is one thing I was talking about when I was talking earlier about other metrics, managerial type accounting. If you'll look, you'll see the average ticket price. So as you can see, Lowe's has done something right, because in 2022, it was $103.64 versus 2020 and 2021, or it's just simply inflation. You would probably look at the inflation rate and determine if really they're actually increasing their average ticket, or if it's all artificial due to inflation. They've also looked at the return on assets, which we'll talk about shortly. So those are other things that companies display in their financial statements. Let's see here. We want to get to so here is cash flow provided from operating activities. So this is kind of their partial statement of cash flow. And they've listed the net amounts from investing activities. And you can kind of see theirs are very detailed in the notes. And we'll talk about the notes in a little bit. So now we're kind of getting into the more detailed things. There we go. So here is Lowe's consolidated balance sheet. And you'll notice at the top, and it's important to be careful when you're reading these things, how are those numbers expressed? Because if you don't read up there, it says in millions except par value. You might think, you probably wouldn't with Lowe's, but with other companies that might do the same thing, you might think, oh, they don't have a lot of cash. So like I said, it's important to, understand. And again, a date and time. You'll see January 28th, 2022, February 3rd, 2023, specific date. And you can see the types of things that they have on their balance sheet. And obviously, we just hit the basics. They have a lot of different accounts that we probably didn't talk about, and it's just above the page, it's above this course, the subject matter of this course. You can see at the bottom, we have, some shareholder information, and you can see that their common stock has a 50-cent par value, and you can see that they've got $5 par value preferred stock. There's none issued, but they have that. And now this is the consolidated statement of shareholders' equity. So this is the last financial statement that we spoke of, or that I spoke of. And if you look at it, you can see you've got the common stock, the shares that were issued, the amount and the dollar amount. Then you've got the value in excess of par. You've got retained earnings. You've got other comprehensive income, essentially. And then it goes the balance of 2020. And then if we go down the page, we can see, okay, this is what happened during the year. We can see that there was some repurchase, looks like, of common stock. And then we have our ending balance. And apparently they've continued to repurchase common stock. So we have some treasury stock going on. So this is what, you can see. And here's the detailed statement of cash flow, just so everybody, sees what's on there. So again, you can see the net income at the top. Net earnings, and you can see the adjustments. You can see depreciation and amortization and other non-cash expenses have been added back. And then you can see the changes in operating assets, or if you will, current assets and current liabilities, and how they affected it. So this company is using the indirect method. And you come down here and you see what they did. What were their investing activities during the year? And then what were their financing activities during the year? And what is their cash and cash equivalents at the end of the year? Now, if you all recall, that number right there is what is listed on the balance sheet as of the end of the year. So all these tie together, as long as you know what to look for. So let's go back to the PowerPoint slides. So sources of accounting information, we're not going to spend a whole lot of time on this because we are running lower on time than I expected. So we've got US GAAP. And generally, the Securities and Exchange Commission is the legal authority to prescribe accounting principles and practices for public companies. They have traditionally left that to the accounting profession. The Financial Accounting Standards Board is who creates all of these pronouncements and the rules of GAAP, essentially. Now, what we have now, which is nice, is we have a Financial Accounting Standards Board accounting standards codification. So we have this nice place where the House of GAAP lives. You can access it online, and it's a research system. It's divided into areas, topics, subtopics, sections, subsections, and paragraphs, and you can search. And generally in this area, we're going to talk about your general principles of accounting. You have presentation, you have assets, liabilities, equity, revenue, expenses, broad transactions, and industries. That's kind of how it's divided up. So, like I said, traditionally the SEC has left the accounting profession alone. They did step in and create the Public Company Accounting Oversight Board with Sarbanes and Oxley, that was created, and then the Sarbanes and Oxley occurred circa 2001, I think. And then the PCAOB was created to kind of monitor the accounting profession after the perceived accounting failures. So that's kind of where we're at. Now, internationally, more countries use international financial reporting standards, and they have an interesting structure. They have the International Financial Reporting Standards Foundation, which are, it's made up of trustees who generally do fundraising and oversee the IASB and the ISSB. So we have the International Accounting Standards Board in the International Sustainability Standards Board, and they kind of make international financial reporting standards. They're the international equivalent of US GAAP. Now, the SEC does permit companies that are foreign companies to use international financial reporting standards. US companies generally use GAAP in their reporting. So what are the key differences? The biggest difference is GAAP is very rules-based and IFRS is very principles-based. There are differences in inventory methodology. IFRS does not permit the use of LIFO, last in, first out. That's kind of like pile of coal here. You go pick up the top piece of the coal, and that's what you're costing out of your inventory. So IFRS does not permit that. US GAAP does. Another goodwill. Goodwill, they basically have the same thing. In impairments, you test annually on goodwill. Intangible assets. Now, when you look at fair value revaluations and intangible assets, the biggest difference between US GAAP and IFRS is that generally International Financial Reporting Standards allows you to, if you've valued something downward, with the exception of goodwill, if you've valued it downward because it's decreased in value, you are able to revalue it upward. You can't do that under US GAAP. Once you've revalued it downward, you can't revalue it upward. Now, you can't revalue intangible assets under US GAAP, period. there's no fair value revaluations there. Cash versus accrual-based accounting. So generally you see this box on an income tax return when you're looking at business tax returns. There's an option that you're going to check that you're a cash basis or you're an accrual basis. And this also extends to accounting. So if you're a cash basis taxpayer, the transaction is recorded when cash is paid or received. Now, many service businesses such as law firms and accounting firms utilize the cash basis of accounting. Now, why would that be? Because let's say we bill our client. Legal services may not be the first thing that they're going to pay. So we don't want to have to recognize income when we send them the bill. We've provided them the services and we send them the bill. We want to recognize income when we receive payment. And generally that's permitted. If we, in most cases, like I said, we don't want to have to pay taxes on income we haven't received yet, or because we don't have the cash to do that. Generally, if you're looking at a cash basis taxpayer's balance sheet, you're not going to see accounts receivables or accounts payables because you only make the entry when you pay for something or when you receive payment for something. Accrual basis. Transaction is recorded when expenses are incurred or revenues are earned. So if I perform a service, I have earned that revenue. So if you were an accrual basis, on the accrual basis of accounting, you would record service revenue and you would end up paying tax on that at the end of the year, even if you didn't get paid for it. Now, most large corporations are required to use the accrual method. There are some exceptions. Now, one of the large exceptions, and it used to be that if you had inventory, you generally had to use the accrual method. Now, there's a smaller business exception. If for the last 3 years, on average, you have 26 million or less in sales, then you qualify for the small business exception and you can use general cash. But it's important to know, if you're looking at a financial statement, is it accrual basis or tax basis, or excuse me, cash basis? And I will tell you, if you're looking at QuickBooks, it tells you in the corner, it'll say cash or accrual. So don't forget to look at that. So you may be looking, you may be looking for some accounts payable and wonder, or accounts receivable and wondering why they're not there. Well, they don't have to be there. Types of businesses. Service businesses, merchandising or retailer, and manufacturing. So it's important to know your business, know the businesses that you're dealing with, because each of these businesses are going to display their financial statements. They're going to have slightly different account titles. Service, provide a service to a customer or client. The main value is not in a physical product. It is in the service. So legal, accounting, medical services. I mean, my client may end up getting a will. I'm going to draft them a document, but the main value is that I've drafted the document, not that I've given them the document. No inventory account. So if you're looking at the financial statements of a service business, you're not going to see inventory. Merchandising or retailer, depending on what you want to call it. These are selling a physical product. Maybe brick and mortar, i.e. Walmart, maybe online, Amazon. Sell various products to consumers. They can also sell to other businesses. Generally, they maintain one type of inventory account, and that's merchandise inventory. Manufacturing businesses make a product to sell to retailers and sometimes directly to the consumer. Ford and Dell. Now, I put JIT, which stands for just-in-time inventory, on there because Dell used to utilize just-in-time inventory. I think everybody may remember the commercial with the guy that said, dude, you're getting a Dell, you order it, they make it, they ship it. So they maintained small levels of inventory because computers become obsolete pretty quick. Manufacturing businesses generally maintain 3 types of inventory accounts: raw materials, work in process, and finished goods. SEC reporting. So The Securities Act of 33 requires companies offering securities, stocks, bonds to the public to file a registration statement. And the Securities Act of 34 established reporting requirements for registered companies. So you can look at the SEC EDGAR's database and find all types of fun information, such as a Form 10K. That is the annual report. That is the no frills equivalent of the Lowe's report that we just looked at. A Form 10Q is pretty much the same, except it encompasses 1 quarter. It doesn't encompass the whole year. A Form 20F is a comprehensive annual report from a non-US company. And Form 8K, it describes significant events that have impacted or may impact the company. So for example, termination of a material definitive agreement or entry into a material definitive agreement. If it's not made in the ordinary course of business, you're going to file a Form 8K within 4 business days and disclose that to the public. There are also other accounting things. If you change your auditor, the person who signs off on your financial statements, you have to disclose that. If you acquire or dispose of a significant portion of assets, that's another reason you would file a Form 8K. If for some reason the registered front company or an agent announces or releases material non-public financial information regarding the results of operations, that has to be disclosed. Creation of direct financial obligations under an off-balance financing arrangement. So you've exported something off of your balance sheet and it's on some that you owe, but you still owe it. It's just not showing on your balance sheet. That would also be disclosed. So those are some of the things that you would see on an 8K. Form 10K, they're going to have a risk analysis. What factors could potentially impact the business, i.e. most businesses right now, you're still seeing a lot of COVID language in there, new regulations, especially for pharmaceutical companies. Those are things that you see. Obviously, we're going to see the financial statements like with Lowe's, management discussion and analysis. This talks about the results of operations. It kind of adds context to the financial numbers. If there is an option to do something, if there is a choice, it will explain what choice the company uses. Okay. Financial statement analysis. We could have a whole class on this probably. So common size financial statements. So it expresses each line item as a percentage of the whole. Trend analysis. This is when we compare year to year and analyze percentage changes. And ratio analysis this is kind of how we compare apples to apples. If companies are different sizes, we use ratios to do that. You have liquidity ratios, which are how quickly a company converts its assets to cash. You have the solvency ratios, which are how well can a company cover its long-term debt, and profitability probably doesn't need a whole lot of explanation. How efficiently the company earns the profits. And the last slide, which is, I wanted to make it too, it kind of ties everything together. Accounting considerations and contracts and deals, liquidated damages. Can damages such as lost profits be reasonably estimated? Obviously, that's going to be dependent on the business and the accounting system. Extraordinary items. Now, these are items that you're going to see on you could see on an income statement. Are there items in revenue or expenses that are unlikely to occur again? Because generally, when you're looking at financial documents, you really don't want to pay as much attention to those. Cookie jar reserves. Sometimes you have to be careful because companies they'll put that money in that cookie jar. They'll keep it in a different account. And then when certain quarters going forward are lean, they will release those cookie jar reserves so they can meet expectations. The last thing I'll talk about is other important documents to review if you're looking at company information. AR aging and AP aging reports. Who owes the company money and how old is it? Like, how long has this been outstanding, and who does the company owe money to? Or is the company paying its bills? Depreciation schedules, those tell you what assets a company holds, what they paid for them, and what they are currently, what their current tax basis is. So I know we got a little quickly there at the end, running out of time. I think our time is up. I don't see any questions. Samantha, do you see any questions?
I'm not seeing any, Holly.
Okay.
If anybody, we could do a couple more minutes if
Oh.
anybody has questions. We have a thank you, Holly, and a great presentation.
Oh, well, I appreciate that. Yes, the slides are available.
Holly, if it's okay, I can get with you and we can send some updated slides and information to everyone following the course, if that works.
No, that would be great. And maybe, I think Jennifer was talking about if there was something everybody wanted to see or they wanted to have more of, maybe you could, a short poll or whatever on.
Yeah, I'm happy to do that. I can follow up with everyone. If you'd like some more in-depth information, for example, an hour on a balance sheet, or any of the topics that Holly's gone over, or an accounting 102. We're happy to provide that. And Holly's been so wonderful to work with us on these webcasts. So I'll follow up with everyone with materials, but also to see what else you'd like to see and what else you'd like to learn in terms of accounting. So I'll be in touch with everybody. I will also get follow up with certification information as well. So stay tuned for that. And thank you so much, Holly, and thank you, Samantha. Yeah, we appreciate it. Looks like I'm getting some more information in the chat. So thank you guys and have a wonderful afternoon.
All right. Thank you.